Hello, I'm Pat McGibbon, and I've got with me Adrian Cooper, the CEO of Oxford Economics. We're here at MFG 2012. Now, Oxford Economics is one of the preeminent forecasters in the manufacturing technology market around the world. In fact, they manage a program for 15 associations from around the different countries in Europe, Australia, India, and the United States on a forecast on a twice annually basis about the 21 major geographic markets and the 8 major industry markets that make up over 90% of all the orders placed for manufacturing technology in the world. But with that, let's get back to some of the things you were sharing with us just a few minutes ago in the conference on the panel. You know, as the people who kind of take a global view on manufacturing technology, how do you see the markets turning over the course of the next 2 years?
Okay, well, clearly these markets have had a great run over the course of the last year or two, really combination of catching up from the recession, but also, for instance, here in the United States, been helped by tax incentives as well. Globally, been helped by booming investment in Asia. This year is going to be not quite so great given that strength of growth, and also given particularly the problems that we've seen in the European economies, which are now in recession. But I think there's a lot of reasons for being positive about the situation in America, particularly given the strength of some of the key machine tool customer sectors like aerospace and autos.
Right. And as far as on a shipment basis, you see shipments continuing to grow in 2012.
Yeah, we do, both globally and here in the United States. And I think there are a number of things that make us positive about the American market, really because we're positive about the American economy. So for instance, we're now in a situation where the US economy is very competitive. We're also in a situation where US companies have a lot of cash that they've been collecting as a result of being so profitable. As they get more confident about the outlook, perhaps as the situation in Europe has eased, we're hoping to see some of that money come out in terms of increased investment spend here at home.
Well, one of the questions I have about I get from our members frequently about your forecast on orders for the United States, order-based forecast, is that how can they have gone from a fairly positive outlook for 2012 to a slightly negative number, a minus 11? And I've shared that my interpretation of the forecast is that because 2011, which originally you were projecting at 50% increase, went to 66 over 2010, that 16 extra points stole something from the future? Yeah,
well, I mean, I think there's a sense in which, 2011 was just so good that when you do comparisons of 2012 over 2011, the growth rates may not look so favorable, but remember, if you can hold on to anything near the level of performance you achieved in 2011, 2012, you're doing great, and that's really what our forecast says.
And then one of the other things that you talk about in your forecast is about the relationship between the dollar and the euro, which I think is one of the few places where you and Alan below, your panelist with you on the forum we just had any kind of a difference. So your view about what's going to happen with respect to the dollar and the euro?
Okay, well, we're of the view that we're likely to see the dollar appreciating further against the euro, and maybe moving towards something like 120. Various factors feed into that. Partly it's the fact that we're more optimistic about growth here in the US than we are for the Eurozone. I don't think that'll be a surprise to anyone. But also it's more medium-term fundamental factors like, for instance, the US economy's expansion in the oil and gas industry, which means that actually we're going to see its dependence on fuel imports declining over the course of the next 5-10 years onwards, whereas fuel dependency in places like Europe is actually going to be increasing. So that trend where the US trade position has been deteriorating, we see stopping. Actually, US trade performance improving into the medium term, which will be good for the dollar.
And economists that talk about our industry and about the impact of certain commodity prices, some of them are saying that they see energy prices growing. You're not really saying that energy prices won't grow, just that our dependence upon foreign, so that those extra dollars we're paying will actually go back to the US as opposed to going overseas?
Absolutely. I mean, in a sense, it's a double benefit for the US, that you've got a growing energy sector and high energy prices, and clearly it's the strength of energy prices is part of the incentive that's creating the extra investment in energy here. So yeah, I mean, we're certainly not saying that energy prices are going to collapse, and in the near term, clearly with the geopolitical situation in Iran and so on, there is a danger they could spike higher for a period. But in terms of growth prospects for the states, the energy sector's really going to be one of the major drivers.
And one of the key reasons why I like to watch your forecast as opposed to many others is because you take the market and break it down by some of our key customer industries and say, this particular customer is going to be doing this in 1 year, and next year this is going to be the mix of investment. Looking out in 2012 and the beginnings of 2013, what are the key industries that are going to be leading the order to intakes for our industry here in the United States?
Okay. Energy again, of course. The other two I'd highlight would be aerospace, where if you look at Boeing, for instance, order books at very, very high levels. The aerospace industry globally benefiting from strong demand coming particularly from Asian and Middle Eastern airlines. The other sector that I think is very promising is autos. We're seeing the benefits now of the restructuring at the big three US manufacturers, but also because of the competitiveness that the US manufacturing sector now has, we're seeing investment coming in, for instance, by Honda and other non-US manufacturers to the sector that I think is going to be beneficial for the machine tools sales.
And going back to the aerospace industry for just a second, taking a peek at your GDP growth figures, I would assume that the growth in the aerospace industry you're talking about is going to be more civilian than defense, pushed by increased passenger miles.
Oh, absolutely. It's the civilian side where we see the real strength of the aerospace sector, and it's a reflection, if you like, of just how well emerging market economies are doing, that the people who live there want to travel. And so their airlines are getting stronger. Actually, as well, particularly in some of the Middle Eastern countries, the leaders there see the aviation industry as one of the strategic growth initiatives. So they're pushing the development of their own state airlines, and that's helping.
Yeah, obviously, I mean, Indonesia, Thailand, China, all are treating the aerospace industry today like a lot of the main economies did the auto industry in the 60s and 70s.
Yeah, and I think that that's a reason for being very optimistic about sales into that sector for US firms, both here and internationally. I think it's a sector where there's a lot of R&D going on. Some exciting new models have been launched, and where demand's very strong.
Stepping outside of our country's bounds, but just a little bit here for a moment, taking a look at Canada and Mexico, our neighbors, what do you see as their prospects for manufacturing technology shipments and demand over the course of the next couple of years? Okay,
well, Canada, if you like, is riding the same energy wave, albeit to an even greater degree than the United States. So that's a great platform for the growth of the Canadian economy and for demand for investment goods in general. Mexico's had a somewhat tougher ride with the cycle in international trade and pressure there's been on currencies as a result of all the liquidity that's been pumped into the global economy. It's also it needs to deal with its bad image that it's getting.
Well, not only bad image, but the challenges of doing business in a place where you're not sure whether you're safe in conducting any kind of business, financially or physically.
Yeah, absolutely. That's critical to Mexico being able to attract the investment that it needs to sustain rapid growth. Absolutely.
When you one of the other points that you made in the panel out here is your faith about growth going out into the long term because of the increase in the middle class around the world. Can you say a couple moments about that?
Yeah, well, I think this is one of the dramatic things that we're seeing. To date, a lot of the growth models in countries like China and elsewhere in Asia have been very if you like, driven by investment, by government initiative. But as those economies get richer, we're seeing an emerging middle class really develop there to a degree that now they're at critical mass when it comes to being markets for consumer durable goods, electronics, cars, and so on. And people's aspirations within those emerging market economies are increasing too. And so we're seeing consumer spending in those regions taking over from investment as a major driver of growth. That's very positive for their long-term prospects and will be an important support to economic growth at a time when maybe people have some doubts about just how robust, say, the property market is going to be in China.
Well, and put it in a sense of magnitude, say 2-3 years from now, where do you see the middle class in China and then the middle class in India being relative, say, to the United States or the EU?
Oh, I mean, these guys are still going to be a lot poorer than we are, but a lot richer than they are today. And we're looking at essentially the size of the global middle class doubling in the course of the next decade.
Size of the middle class doubling in the next, of course, the next
decade.
So that they will, those two countries and some of the others that are working with them, like Russia and Brazil, will increase our middle class by about twice what we have today.
For the world as a whole, absolutely.
That means twice the demand.
Yeah.
And means twice the manufacturing output needed.
Yeah, absolutely, because as they get richer, the sophistication of the things they're going to be buying increases, and that's the thing that gives the extra leverage to the manufacturing sector, I think.
Well, that's excellent news, because so far in the course of the last 5 or 10 years, we've seen the productivity in the machines that we've been putting in our customers' hands outstrip the need for additional capacity. So we've seen values go up in orders, but the unit count's going down. What you're saying is that we could possibly see a significant increase in unit count over the course of the next 10 years.
Yeah, I mean, people often worry about the emerging markets as a threat. They see it as a competitive threat to US manufacturers. But the growth of emerging markets and the growth in the middle class, that's the big opportunity for US companies.
And one of the other encouraging points you made on the panel there was the future of your concepts and outlooks for the future of manufacturing as a whole in the United States. Could you share a little bit of that with us? Yeah,
well, I mean, I think that's a lot to do with the excellent performance that US manufacturers have had over the last decade in controlling their unit costs. So they've kept wages under tight control, but they've also driven productivity increases. So over the last decade, in dollar terms, US unit labor costs have not increased at all. In China, they've gone up 2.5 times. So, I mean, it may still be absolutely cheaper to hire a worker in China, but take into account productivity and look at the relativities. Things have moved very much in the US's advantage. That is changing the landscape for investment in the manufacturing sector worldwide. Layer onto that issues about control, issues about IP, issues about where you can find the best workers with the sort of R&D skills, etc. that you want, and issues about closeness to market, particularly in a world of high transport costs and energy prices, makes the US very, very much more attractive, and increasing number of anecdotes of companies who were thought they were going to invest in Asia, but changed their minds and ended up investing here.
Well, absolutely. When you think about 2.5 times increase in the Chinese labor rates, even though they're still a fraction of the US, you add on to the fact that you and Alan both were saying a 20% increase in energy prices sometime in the very near future and a potential of doubling in the next decade. That's going to make logistics costs a much higher percentage of the overall cost impact of doing something overseas than ever before.
Yeah, absolutely, and we're really seeing that. Yeah, and we're seeing it in terms of, for instance, the Honda's announcement is going to invest $800 million in the United States over the course of the next couple of years.
$800 million.
Yeah. So I think it's all very positive. Lots of things are working together to encourage the revival, maybe putting it slightly too strongly, but perhaps not, of manufacturing.
So as we move towards March of 2012 into September of 2012 and IMTS, you got the exhibitors about to hit the floor. In your perspective about where the best customers are going to be coming from and what the biggest needs are going to be, what kind of advice would you say to an exhibitor about trying to identify what customers he wants to go after?
Okay, well, follow the cash.
So energy, aerospace, medical equipment.
Yeah, absolutely, and the US, but Germany too.
Oh, Germany, yes.
I don't rule out the whole of Europe just because of the problems associated with the Eurozone and places like Greece and Portugal. The German economy too is fantastically competitive and has actually managed to continue to grow despite all this trouble in its hinterland. So look there, but also Asia China especially, the prospects for growth are such that demand's still going to remain very strong there.
And you're not looking for any kind of a dip anytime in the next couple of years with respect to the demand for manufacturing technology?
Well, I mean, there are things that could go wrong. We're not necessarily out of the woods as far as the European situation goes. Right. So there's some wild cards that could yet hit us, and I want to emphasize it's still very uncertain.
Right.
But if Europe continues to get its house in order, and it's a big if, then I think the prospects for the US and emerging market economies driving a strong global recovery are good.
Okay, and so you mentioned wild cards. What are the 3 wild cards our guys should watch out for over the course of the next year or so?
Okay, the 3 things I would watch would be the Eurozone situation unraveling again. Okay, at the moment we have a sticking plaster that stopped Greece defaulting. We haven't yet got a strategy to get those economies growing.
Right.
They'll need that if they're not going to default. The second thing I would watch is the Chinese property market. We're seeing prices correcting, but there's been so much of Chinese growth driven by investment in that sector.
Right.
That could turn off, and even though the Chinese government has got enough money to bail out the banks if there are any bad loans and so on, going from a situation where investment's running at 30% a year to one where it's 0 is enough to knock a big chunk off Chinese growth. The third thing we have to watch is the oil price, and the danger that something could happen in the Middle East that sparks it to rise. Well, 150 is easy to see. Things get tense, 200 could be a possibility.
Okay, so I've got Adrian Cooper with Oxford Economics, Pat McGibbon, MFG 2012, and the 3 things to keep an eye on: what's going on with the EU, the property markets in China, and any kind of disturbance that could see our oil prices and energy prices grow by almost 50% in the near term. Thanks, and we'll see you at IMTS.
Need to connect with your customers using social media? Be there with IMTS.com. Everyone has been chatting about connecting with their fans or customers on Twitter and Facebook and other sites to discuss or bemoan what's happening. So what does this have to do with manufacturing? Everything. That's because social media isn't an isolated tactic. It is just one of the tools you can use to connect and engage your customers. Ask them how their business is faring. Ask them what they think about the current political atmosphere in Washington. Or ask them how you can help them succeed. Another social media option, and one that can increase traffic to your website by 55%, is to write a blog. Ask your employees. Some may already be writing blogs on their own. Engage them in promoting your company, your products, or your services. Have them write about how they help a customer, or better yet, ask that customer how your employee helped them. Everyone is talking. Are you part of the conversation? People don't buy from companies or a website, they buy from people, and they are more likely to buy from people they know or feel connected to. So connect with the IMTS show on Facebook, Twitter, or LinkedIn, or read our blog by visiting imts.com/blog. IMTS.com. Be there, online with your customers.